All right, welcome everyone. If you're going to be a leader in the business world, you absolutely have to speak the language of business. And that language, well, it's accounting. So today we're going to get to the bottom of a really fundamental question, something that's at the heart of all financial reporting. How do we actually put a number on the stuff a company owns? Now, I know what you might be thinking. Accounting, that's for the number crunchers in the back. But trust me, this isn't some technical, boring exercise. Understanding this is the key to unlocking a company's real potential and making those big strategic moves that drive growth. So let's jump right into the deep end. Picture this. You're the CEO. It's the end of the quarter. The board is waiting. On your books, you've got two major assets. First, there's your main office building, which you bought 20 years ago in what's now a super hot part of town. Second, you've got a big chunk of stock in some hotshot tech company that you literally just bought. So here's the million-dollar question. How do you value these two things tonight? For the building, do you use the price from 2 decades ago or what it's worth now, which is way, way more? And that stock, it's already jumped 10%. What do you do? This is the valuation dilemma. And believe me, how you answer this changes everything about how investors see your company. To figure this out, we've got two main tools, two guiding principles. The first one is what's called the historical cost principle. I like to call it the anchor of accounting. And that's a good way to think about it, right? Imagine a ship just getting tossed around by every little wave. You'd have no idea where you are. Well, it's the same for a company's finances. Investors, banks, they need a stable, reliable point to make their decisions. And that's exactly what historical cost does. It provides that anchor, tying the value of an asset to a solid, verifiable point in the past. So what is it exactly? Well, the historical cost principle is pretty straightforward. You record an asset at the price you originally paid for it. That's it. That number is often called its book value. So if your company buys a piece of land for, say, $100,000, that's the number that goes on the balance sheet. And it stays at $100,000, even if the market goes crazy and that land is suddenly worth double next year. Now, why be so rigid? Simple, because the original price is a fact. It's a cold, hard fact. You can prove it. It leaves zero room for anyone to just make things up. Without it, a CEO could just say, I feel like our building is worth more today. And poof, the company's value goes up on paper. That'd be chaos. In this right here, this is the core of why historical cost is so foundational to accounting. It all comes down to building trust. When investors look at your financial statements, they need to believe the numbers are real. Objectivity and verifiability mean there's a paper trail. An auditor can look at a contract or a receipt and say, yep, that's what they paid. Consistency means you're comparing apples to apples over the years. And all of that together gives us reliability. And reliability, that is the bedrock of our entire financial market. It's what gives people the confidence to invest their money in a company in the first place. Let's look at a quick example. Here's our pretend startup, Innovate Co. In 2023, they buy a building for $500,000. Okay, a year later, the real estate market in their area just explodes. Let's say that building is now easily worth $1 million. But look at the book value on Innovate Co.'s balance sheet, still $500,000. The next year, the market cools off a bit, maybe it's worth $800,000. The book value? You guessed it, still anchored at $500,000. Now, this stability is a double-edged sword. On one hand, it's great. It shields the company's financials from all that crazy market volatility. But on the other hand, it's hiding the true current economic reality of that asset. And as a manager, you have to be totally aware of this hidden value that's not showing up on the official reports. Okay, but what if stability isn't what you need? What if for a certain decision, you need to know what something's worth right now? That's where our second principle comes in, fair value. If historical cost is the anchor holding you to the past, fair value is the mirror. It couldn't care less what you paid for something yesterday. All it does is show you exactly what your assets are worth in today's market, warts and all. At its core, the fair value principle is all about one word: relevance. It allows, and sometimes it actually requires, companies to report certain things at their current market value. Basically, what price could you get for it if you sold it today? This is absolutely essential for assets that are bought and sold all the time, like stocks and bonds. For those kinds of things, what you paid for them ages ago is almost meaningless. What an investor really cares about is what they're worth today, because that tells you about the company's ability to generate cash and make new moves right now. Now, let's flip the script. Put yourself in the shoes of an investor for a second. You're thinking about buying shares in a big bank. Do you want to see a balance sheet that values the bank's gigantic investment portfolio based on what they paid 5 years ago? Or what it's all worth as of this morning? I mean, it's a no-brainer, right? You want the most up-to-date, relevant info you can get your hands on. That's the power of fair value. It gives you that clear, timely, and accurate picture you need to make a smart decision. Let's check back in with Innovate Co. In the first quarter, they put 100 grand into the stock market. Great. In Q2, the market goes on a bull run, and now their investment is worth 120,000. So their balance sheet gets updated to show that gain. But then in Q3, the market dips a little. Their portfolio value gets adjusted down to 115. And that's the reality of fair value accounting. It's a real-time snapshot for sure. But it also means the company's books are on a bit of a roller coaster, reflecting every up and down of the market. And all that volatility can make a company seem a lot more or a lot less stable than it really is. So, which one wins, the anchor of historical cost or the mirror of fair value? Well, here's the twist. Neither of them. The truth is, a modern balance sheet isn't one or the other. It's a hybrid. It's a mix of the past and the present. Think of it like a financial time capsule. Some assets are frozen in time at what you paid for them, while others are constantly updating to show you what's happening right now. And your job as a future leader isn't to pick a side. It's to understand that this is a hybrid system and be able to read the different stories both sets of numbers are telling you. This slide right here really captures the whole dilemma in a nutshell. On one side, you've got the solid, dependable anchor of historical cost. It's objective, it's reliable. But its big weakness is that it can be totally out of date, completely ignoring huge changes in value. Then on the other side, you've got the crystal clear mirror of fair value. It shows you exactly what's happening today, but it brings all that market volatility with it. And for some assets, it can be a bit subjective. The real skill, the real art of financial analysis is knowing this trade-off and understanding when to trust the anchor and when you really need to look in the mirror. So how do companies actually decide which to use? Well, it really comes down to one simple question. What are you planning on doing with the asset? If it's something you use for your core operations, something you're going to hold for the long haul, like your factory, your machines, your patents, then historical cost makes the most sense. You're not planning to sell them tomorrow, right? You're using them to make money over many years. But if you're holding an asset purely for investment or trading, stocks, bonds, then you've got to use fair value. It's the only way to go because their value is tied directly to the market, and that's the info everyone needs to see. But hang on, what happens when that historical cost anchor becomes a dead weight? Just imagine a company bought a fleet of gas-guzzling trucks for $1 million. But a few years later, new regulations come out, and these super efficient electric trucks hit the market. Suddenly, that old fleet is basically obsolete. It would be totally misleading to keep them on the books for $1 million, right? And that's where a concept called impairment comes in. Think of it as a reality check. It's a rule that says if an asset's value has permanently dropped way below what you paid for it, you have to write it down. It's a super important tool to make sure financial statements aren't just wishful thinking. Okay, so we've been deep in the weeds of accounting principles, but I promise you, this isn't just about passing your final exam. As a business leader, you are going to use this exact information to make huge decisions every single day. So in this last section, we're going to shift gears. We're moving from theory to practice. We're going to talk about how you can use what you've learned about this valuation dilemma to create real, actual value for your company. So here it is, a simple 4-step playbook for putting this knowledge into action. Step 1, you look at the balance sheet, find the asset's book value. Step 2, you do your homework, get an appraisal, check what similar things are selling for, and figure out its real market value. Step 3, and this is the most important part, you analyze the value gap between those two numbers. This is where you find hidden value or sometimes hidden risk. And finally, step 4, you figure out how to use that gap to your advantage. Let's imagine we're in the boardroom at Innovate Co. and see how this plays out. Okay, team, listen up. We're here to talk about our expansion. Now, the banks are a little nervous about giving us the loan we need, and it's because they're just looking at our balance sheet. They see this building listed here at its historical cost, 500 grand, and they're not impressed. But here's what they don't see. They don't see the $2 million appraisal we just got for this property. That is a $1.5 million value gap, and that, my friends, is our leverage. We are going to walk into that bank, we're going to show them our financials, and we're going to show them this appraisal. We're going to tell the whole story, and we're going to use that hidden value as collateral to get the money we need to grow. You see how that works? The book value is just the start of the conversation. The real strategic thinking, the real magic, happens when you can tell the story behind the numbers. Now, let's talk about some traps that I see so many students, and honestly, a lot of professionals fall into. The biggest one, by far, is mixing up book value and market value. They're almost never the same number, so you have to dig deeper. Read the footnotes on the financial statements, do some research. Another mistake? Getting way too excited about rising fair values and forgetting that what goes up can also come down. A smart manager always plans for that volatility. But the most important thing is to be a critical thinker. Never, ever just take a number at face value. Always be the person in the room who asks, okay, where did this number come from, and what does it really mean for the decision we're trying to make? Look, as you go out and start your careers, you're going to face one tough decision after another. And your ability to make the right call is going to depend on how well you can read and understand financial information. This valuation dilemma we've talked about is right at the center of that challenge. It's a constant balancing act between the solid ground of the past and the choppy waters of the future. So I'll leave you with this question to think about. When the pressure is on, when the stakes are high, are you going to trust the safety of the anchor? Or will you have the courage to look into the volatile but very real reflection in the mirror? Your answer to that is going to define the kind of leader you become.